Okay, today this presentation will be on industrial buildings. To start with, we need to know what we mean by industrial building for tax purposes. Okay, we need to know what we mean by industrial building for tax purposes. So let me just admit somebody. Okay, that's what we have. We have industrial building for tax purposes. Okay, so what do we mean by industrial building? Industrial building can be described as a building or a structure in use for the purpose of any electricity, gas, water, inland navigation, transport, hydraulic power, bridge or tunnel undertaking, or anything similar to what I've mentioned of public utility, or is in use for the purpose of any trade which is carried on in a mill, factory, or like premises. We advise that industrial building consists of manufacture of goods or materials or their subjection to any process. So that's what can be considered industrial building. Furthermore, we are advised to say that industrial building consists of the storage of goods on import or export, or consists in working of a mine, well for the extraction of natural deposits. Okay, that's what is an industrial building. Now, in relation to the previous presentation, where we were looking at the implements, plant and machinery, you remember I did emphasize on the aspect of plant, where I'd guided to say in the Income Tax Act, the definition of plant is not given, but we are given instead the guidelines of how to determine what is plant. And I did mention that for a plant, it is identified by using a functional test, where I said that a plant is considered to be an apparatus, not the setting in which the trade is carried out. So particularly I did mention, draw parallels to a situation where you have a machine that is housed in a building. Okay, that machine is used to produce products, for instance goods, and the building is the setting in which this particular apparatus, in this case the machine, is found. So we did say that the building is not part of plant, it's the machine which is the apparatus. Why did we distinguish that? Because the buildings have their own way of being treated, so that we claim capital allowances on building. Thus we have this particular section which is talking about industrial building, and we are going to see what type of capital allowances are attributed to industrial building. Later on we will look at also capital allowances which are attributed to what are called commercial buildings. So that's the idea. So I've explained what industrial building are. So let's look at what other things can be said about industrial building. We can say that industrial building includes therefore those used for a trade in a mill, factory or similar premises, the manufacture or processing of goods or materials, the storage of goods or materials. So that is what an industrial building can mean in summary. Okay, so particularly when it comes to manufacturing, what can be said about a building that is used as a manufacturing facility? In general, a manufacturing trade is one that subjects an item to a process which is in some way going to change the character or the form of those materials. That's what we can say about manufacturing. What is produced by the process should be commercially useful. Okay, that's another point to note. And also manufacturing is interpreted in functional ways, so that while offices would not qualify as industrial building, engineering drawing offices have been held to qualify. Okay, so where you prepare those drawings for the technical specification, those are part of industrial building, whereas ordinarily they would have not qualified because offices are taken to be commercial buildings. Okay, so that's what we can say. Okay, specifically excluded from these classifications as industrial buildings are dwelling house. Okay, a dwelling house is where you are kept as a place to stay in. For instance, employees can be staying in a particular building with families. That is a dwelling house. Another item that is excluded from this classification is a retail or wholesale premises. Also showrooms. Okay, because showrooms meant for products that's already finished, so they have been brought to completion. They are just on display to woo customers. So those are showrooms. So there is no manufacturing taking place in that particular case. So that cannot be an industrial building, fitting the definition of an industrial building. Furthermore, we exclude offices. We also exclude buildings which are used for the purpose of a retail trade, repair or service trade, or trade of a similar nature. Okay, so when you are looking at an exam question and you want to know which type of capital allowances will be applied to this building, look out for these particular points to help you decide whether it's an industrial building or not an industrial building. Okay, apparently there are those buildings which might not ordinarily fit into this particular description of industrial building. One of them is hotels. Okay, it is included on the premise that provided the hotel meets the conditions of qualification, it will be treated as an industrial building. Okay, a qualifying hotel should be that satisfies the following conditions. One, the building must be a hotel in the first case. Okay. Secondly, the building must be open for at least 4 months. That is 120 days in the session, or that is from April to 31st October each year. Thirdly, when open in the session, the hotel must have at least 10 bedrooms that are available for short-term letting to the public, not more than 30 days per letting. Okay, so that is what can be considered a hotel to be included as industrial building for tax purposes. Furthermore, we can say that when open in the session, the services provided must normally include breakfast, evening meal, room cleaning, and making of beds. Okay, this is what is a hotel, and this hotel is part of the industrial building. The other qualifying aspect is that a hotel should meet the standards. Okay, a hotel should meet the standard as prescribed by a government agency responsible for regulating hotel industry. So that's what is also important in this particular regard. That's when it can be a qualifying asset for industrial building purposes. Okay. Now, what is important also when you are dealing with industrial building is to be aware of what is known as qualifying costs, especially when it comes to construction. For a building, you can acquire it either by taking or getting a completed structure where it is sold to you, so you get a completed structure, or you can acquire a building by way of construction. So the cost of construction will make up the cost of the building. The qualifying cost will be calculated from that point. Okay. Now, in looking at the qualifying cost for construction, expenditure must be incurred in construction. Therefore, the cost of land and incidental expense associated with it, with its acquisition, does not qualify for industrial building allowances. Okay, that much you should know. That's a point you should know. According to the Income Tax Act, the cost of land is not part of the qualifying cost. Okay, the cost of land is not part of the qualifying cost. Also, what you take out from the qualifying cost is if at all there is a subsidy through the help of the government, you have a subsidy in acquiring that particular building, that cost should also not be part of the qualifying cost. The third item which is not part of the qualifying cost is where you have a grant from public funds. Where you have a grant from public funds, again, that should not be part of the qualifying cost. Okay, so however, the incidental cost to make these costs qualify for industrial building allowances include expenditure incurred in digging foundation. Also, there is expenditure incurred in preparing the land. There is also expenditure that can be incurred to pay architectural fees. Okay, then also what is important according to the law is to realize that the expenditure incurred in the construction or expansion of a hotel on or after 1st April 1966 and certified by government board responsible for the hotel industry as meeting the relevant government standards is part of the qualifying cost, part of qualifying asset for industrial building allowances. Okay. Also, expenditure on the construction of a building that is used for the welfare of employees engaged in the undertaking and the trades qualify. Okay, so those are going to look at things like canteen is an industrial building because it is used for the welfare of employees engaged in the undertaking. Okay, so you'd be finding the things like the canteen as qualifying costs. Okay, also the cost of maybe if you have a place where employees live, maybe their children, daycare center, like that, so that they concentrate on work, that will again will qualify as an industrial building if they're part of the building. Okay, any building acquired or constructed for the purpose of providing housing for the purpose of the business at a cost that does not exceed a certain prescribed amount, that can also be part of the qualifying cost. Now, this limitation is relating to what we call low cost housing. This is relating to what we call low cost housing. A low cost house is one that is constructed with a total cost of construction not exceeding 20,000 kwacha. That is a low cost house. Okay, that is a low cost housing, and it should be a dwelling. Okay, it should be the dwelling place where the employees stay. That will be a low cost housing, and it will also be qualifying for industrial building allowances. We are going to come back to this particular point relating to low cost housing because it has its own set of it has really one point where it is different from the other industrial building for capital allowances purposes when it comes to wear and tear allowance. We'll come and look at that in due course. Okay, then we look at the things like professional fees. I can talk about something about professional fees, notably those of architects incurred as part of the construction project qualify for industrial building allowance. That is just to emphasize about professional fees. These, as I've said, talk about, for instance, architects' fees. Okay. Now, there is also what can be talked about as a non-industrial part. Okay, non-industrial part. So, what happens with non-industrial part? Okay, non-industrial part are those which are buildings that have nothing to do with the conversion of materials to finished goods, or basically production or manufacturing, as we have described for industrial building for capital allowance purposes. These include, as I've singled out, things like a showroom. Okay, that cannot qualify as industrial buildings. That is non-qualifying part. We can also have, for instance, offices. Those are non-qualifying parts. So non-qualifying parts. So that's what we can talk about as non-qualifying parts. Now, why do we talk about non-industrial part in this particular part question, or in this particular situation? The reason is that sometimes the situation provides itself where a building has a component, or there is a portion of the building which is non-industrial. You can have the whole building which is put there, and then you find that part of the building is comprised of non-industrial parts. So how do we treat that? So the issue is there is a test that needs to be carried out to find out whether the portion of the cost which is non-industrial part is significant or not significant. So the test is to find out if the non-industrial part costs more than 10% of the total qualifying cost, then it is significant. In that particular case, it needs to be removed as another deduction, okay, to arrive at finally the qualifying cost. If it is less than 10%, then it is taken to be insignificant. Therefore, we just ignore as if it doesn't exist, or as if the whole building is the industrial building. So that's what we're going to look at. Okay. Also talk about capital expenditure on alterations. Okay. Capital expenditure on alteration to existing industrial building also qualifies for industrial building allowances. There are kind of alterations that can be experienced on a building, so those also qualify for industrial building allowances. So let's look at the total cost of construction. Okay, what can we say about the total cost of construction? The total cost of constructing a qualifying building is eligible for industrial building allowance, subject to rule on non-qualifying parts of the building, as I've already highlighted. If the building was acquired after construction, yes, please. Yes, please.
I don't know if it is my network or something. The slides are not changing. It's still on industrial building.
Okay, let me look at that. Okay. Cascade effect. Okay. Okay.
That can do. Fantastic. Yeah, just we'll be done just now. This person had not put the numbers out. We managed to get it off 2027.
Are you able to see the slide now?
Okay.
Are you able to see the slide?
Right. So as
yes, it has changed.
You are able now?
Okay.
Yes, sir.
Okay, back to business. So we are talking about total cost of construction. The total cost of constructing a qualifying building is eligible for industrial building allowance. Okay, of course, not forgetting that we supposed to subject this to rule on non-qualifying parts of a building. Non-qualifying parts of the building are basically those parts of the building which are taken to be commercial building. Because if a building is not industrial, then it should be commercial building. Okay? We're going to look at that. And if the building was acquired after construction, but before use, the eligible expenditure depends on the type of the vendor. Okay? The eligible expenditure depends on the type of the vendor. Okay? When the purchase from a builder, the eligible expenditure is the purchase price. Okay? So that's what it means, including the builder's profit margin. Otherwise, it is the lower of the purchase price and the construction expenditure incurred. So that's what you're supposed to look at. Okay. Now let's look at an example so that we understand the points that have belabored on. Okay. So we have Jumbo Limited erected a factory for use in its manufacturing business during the tax year 2022. Okay, the total cost of construction of 370,000 was apportioned as follows: is freehold land 60,000, cutting and leveling of site 2,000, construction of building comprising employees canteen 12,000, general offices 29,000, and factory 267,000. That brings us to a total 370,000. So what are we required to do in this particular case? We have these tasks, two tasks. One, to calculate the qualifying cost for industrial building allowances. B, to calculate industrial building allowances during the charge year 2022. Okay, so that's what we're supposed to look at. Okay, so now how do we proceed with this? So the first thing we do is consider 3 portions of cost which needs to be taken out of the 370,000. Okay, I did mention, yes.
And requesting for the next slide.
Come again?
Yes, we are kindly requesting for the next slide, the question exam. We are still on total cost of construction.
Okay, I think let me just get back to this one. Okay, you have that one. You're able to pick it now? Are you able to see now?
No, sir, still on total cost of construction.
Okay, I think it's the issue of the network.
We can see it now, sir.
Okay, fine. So I'm showing you this example, which we are supposed to look at. You're able to follow now? So we have Jumbo Limited erected a factory for use in its manufacturing business during the tax year 2022. The total cost of construction of 370,000 was apportioned as follows. So we have the freehold land 60,000, as I've mentioned. We have all these other costs. Now the task we have before us is to calculate the qualifying cost for industrial building allowances, and then secondly to calculate the industrial building allowances during the charge year 2022. Okay, so how do we determine the qualifying cost? So out of the expenditure of 370,000, we need to remove non-qualifying costs, which are made up basically of 3 things. One, if there is a subsidy which was used towards the acquisition of this or construction of this particular building, that has to be taken out of the 370. Do we have subsidy here? We don't have. So we move to the next one. If there is an indication that the construction of this building had enjoyed a grant from public funds, from the government, that has to be taken out as well. Do we have the grant here? We don't have. The third one is the cost of land. Okay, we have freehold land is showing that 60,000. That has to be taken out. So since the other two are not there, we only have land of 60,000 and we take it out from 370. So we are going to take out 60,000 from 370, meaning that you have now a cost of construction for the whole building sitting at 310,000. Are we together? 310,000. Are we together? Okay. So now the other part, which needs to be looked at is now find out if there is any non-qualifying part, meaning that in the building there is a portion which is not an industrial building. So let's go and see what happens. When you look at this particular breakdown, we see freehold land 60,000. We have dealt with that. Cutting and leveling of site, that is preparing the land, that is qualifying cost. Then we have also construction of the building comprising of employees canteen, 12,000. I did say that the canteen is an industry part of the qualifying part of the industrial building. Why? Because it is there to take care of the welfare of the employees. So it's an industrial building part. Then we have general offices. General offices, as you can see, it's not talking about anything to do with manufacturing, so that is left out. The factory, of course, is an industrial building. In the factory, you produce goods. That is an industrial building. So what is standing out odd is general offices. So general offices is a non-qualifying part of the building, amounting to 29,000 kwacha. So the next thing we do is we have to find out whether these 29,000, which you are seeing here, these 29,000 of the total qualifying cost after deducting the non-qualifying parts. Okay, in this particular case, if I look at this, we find we have got 310. So we want to compare now. Okay, we tell a test. We find out whether 29,000 out of 310,000 is above 10% or not. So we do the calculation. 29,000 divided by 310 times 100, we find that is 9.35%, less than 10%. Hence, the industrial building allowances will take that component of general offices to be insignificant portion of the total cost, and we just ignore it as if it didn't exist. We just pick the figure 310, okay, as a qualifying cost for industrial building allowance purposes. Had it been more than 10%, would have further deducted 29,000 from 310. So this is not the case, because 29,000 is less than 10%, is 9.35%. So we just ignore it and just concentrate on 310 as a qualifying cost finally for capital allowances purposes. Are we together? Are we together on this point?
Yes, sir.
Yes.
Okay, fine. So let's move now to look at the second portion where we calculate the capital allowances. Now you should know that capital allowances for industrial building are claimed as follows. Capital allowances for industrial building are claimed as follows. Okay, on this particular score that we have, let me just look at this. Okay, for I can talk about the type of capital allowances. Okay, capital allowances, industrial building allowances, rates. Okay, rates of capital industrial building allowances. Okay, maybe say rates of industrial building allowances, capital allowances, rates. Okay. Okay, say rates of industrial building allowances. Okay, fine. What do we have? We have initial initial capital allowance, initial allowance. This attracts a 10% on original cost. We also have an investment allowance. That's also attracts a 10% on original cost. We also have wear and tear. Wear and tear allowance. That attracts a 5% rate. Okay, so that is what we are going to apply now. Just to shed a bit of light on this, okay, just to shed a bit of light on this, the first two, which is initial allowance and investment allowance, these can only be claimed on qualifying costs in the first year of use of the building. So when the building is first commissioned, whoever starts using it is, as the owner, is in the one who is entitled to claim the initial allowance at 10% and investment allowance. Further to wear and tear allowance, of course, meaning that in the first year of use, the owner will claim 3 types of allowances for industrial building allowances. This is initial allowance 10%, investment allowance 10%, wear and tear allowance 10%. But in the subsequent years, subsequent to the first year of use, the only allowance that will be claimable is wear and tear, which continues at 5%. So that much you should know. Okay. Now, again, you should be in a position to understand that you can acquire a building which is a second-hand building, means that you are the one, not the first one to use it. As you buy the building which is a second-hand, it means that the new owner, okay, the new owner can only claim wear and tear allowance at 5%, because the initial and the investment that would have been claimed already by the first user. So that much you should know. Okay, so that much you should know. So now let's continue and look at how we calculate these allowances for industrial building. Okay, so we have settled for the qualifying cost as 310. That's what you are seeing here under the column value. Okay, so we subject, since the building of this building is put to commission for the first time, means that the owner will claim the 3 allowances in the name of initial allowance, investment allowance, and wear and tear allowance. So we have the initial allowance 10% of the original cost, qualifying cost 310, which is 31,000. So you claim everything. There is no divided use. Then you have investment allowance 10% of 310, that is 31,000 there. Again, you claim all of it because there is no divided use. Then we have wear and tear allowance of 5%, which is half that. So you get 15,500. So then you write down the qualifying cost 310,000 by these 3 allowances. You end up having the income tax value carried forward of 232,500 written down value. So meanwhile, the total capital allowances claimed in the charge year 2022 will be 31,000 plus 31,000 plus 15,500, which comes to a total of 77,500. 77,500. Those are the total capital allowances charged for the charge year 2022. So that's how we calculate the capital allowances. They are pretty straightforward. There is nothing to hassle around. Okay. What can we talk about the written down value or the income tax value? Okay. It is important to take note of the following, that the income tax value For industrial buildings, these are deemed to have a tax life of 20 years. Okay, tax life of 20 years. Why?
Thank you so much, guys. That's what
Because the wear and tear allowance is 5%,
Okay.
meaning that in 100%, the 5% can go in 20 times. So it will take care of 20 years from the day the building was first used. So then the next thing is you look at the tax life. Okay, the tax life is important as no balancing adjustment to arise on the sale of building after 20 years. So that is very, very important. Similarly, no industrial building allowances are available to the purchase of the building where tax life has already elapsed. So why is this so? It is important to take note of this because in an exam question, what can happen is that you can be told about the time when the building was commissioned, and then when you actually count the number of years to the time when you are being asked to calculate the capital allowance, you might find that the 20 years could have passed, means that you do not qualify to claim capital allowances because the time has lapsed. You have crossed over 20 years. Okay, we have crossed over 20 years. So you can only claim capital allowance within the period of 20 years from the date when the building is first commissioned or first put to use. So that's the idea. The income tax value is important to consider in that respect. Okay, I hope I've made myself very clear. Okay. Now, what happens when there is a sale of a building? What happens if there is a sale of a building with non-industrial use? Okay. Let's say you have on disposal of an industrial building, a balancing adjustment is computed. Just like before, we learned when dealing with implements, plant and machinery that in the year of disposal, you do not calculate capital allowances. Instead, you determine whether there is a balancing charge or balancing allowance. Okay, how does the balancing allowance arise? Okay, we noted that balancing allowance will arise when the disposal proceeds are less than the income tax value at the start of the charge year in question. Then you have a balancing allowance. Okay, but a balancing charge will come when the disposal proceed, okay, is greater than the income tax value at the start of the charge year in question when the disposal is being made. Okay, so that's what we came to learn. Okay, so the same applies to industrial building. Okay, the same applies to industrial building. Okay, yeah, so that's what is being emphasized here. Okay, this is what is being emphasized here. So the same applies as I've already emphasized. So the same rules will apply, whereby you cannot have disposal proceeds which are above the original cost. So that is also looked at. Okay, so that is also looked at. Okay, let's look at an example again and see how we can handle this particular one. Okay, assume the expenditure on industrial building was as in the previous example, that is Jumbo Limited. Remember, we have just dealt with Jumbo Limited. The factory was completed and paid for on 1st June 2012 and taken into use on 1st August 2012. Jumbo Limited prepared accounts to 31st December. On 1st August 2015, okay, the factory was sold for 500,000, including 100,000 for land, to Mumbo Limited. From Jumbo to Mumbo Limited. Required, compute the industrial building allowance available to Jumbo Limited for each of the years concerned. Okay, so for each of the years concerned. Okay, so that's how it is. So we sold this building to Mumbo on 1st August 2015. So meanwhile, from 1st June 2012 all the way to 2015, this was in the name of Jumbo Limited. So Jumbo Limited was entitled to claim capital allowances because the owner, until it was sold altogether. So that's what it is. So how do we go about it? We look at that. So qualifying costs on the 1st June 2012, 310,000. Okay, so that's when it was built. So he is entitled to initial allowance 10% as before. We have 31,000. Investment allowance 10% as before. We have 31,000. Wear and tear allowance as before. We have 15,500. The income tax value is 232,500. For charge year 2022, the total capital allowances as before is 77,500. There's no problem with that one. Okay. Then we'll look at the charge year 2013, which is the following year. Okay, the charge year 2013. Charge year 2013, what happens? You cannot claim initial allowance, you cannot claim investment allowance because these are subsequent years. What you can claim only is the wear and tear allowance, which is 5%. So you apply the 5% on the original qualifying cost of 310. You have this is going to be 15,500. Not this one is 15,500 for the typo. 15,500. Okay, like that. Even here it's supposed to be 15,500. Okay, 500. Okay, so that's what it's supposed to be. So when you remove that one, it simply means that this one will be that will be 7, and then that will be 1. Okay, so 17,000 kwacha will be income tax value. 17,000 kwacha will be income tax value 2013. We move on to 2014. 2014, what happens? We are selling off the building. So we are selling off the building. So we had income tax value carried forward in 2013 of 217,000. That is what we start with, 217,000. That is what we start with, 217,000 kwacha. Okay, brought forward from 2014. Let me see, 2014. Okay, so 2013, when was this building sold? The building was sold in August 2015. So there is 2014 in between. So there is 2014 in between. It needs to be calculated or catered for. There is 2014 in between. So meaning that we have to take note of that. This is just 2013. We need also 2014. We need 2014. We need 2014. So we have charge, that's value. We also have capital allowance. Capital allowance. Okay, we have capital allowance as well. Okay, after capital allowance, we say this is a charge year. 2014, that's the charge year. This needs to be included. Charge year 2014. So in charge year 2014, what do we have? Okay. Yes. Charge year 2014, what do we have? We have to bring the income tax value. Okay, this is stubborn. Okay, the income tax value. The income tax value. The underlining. Income tax value, which is brought forward from 2013. And what are we bringing forward from 2013 is 217,000. So we're bringing 217,000. 217,000. That's what we are bringing forward. Okay? And then we go ahead and claim capital allowances. Claim capital allowances as well. That is wear and tear allowance. Okay, which is at 5% of the original cost. So it means that we still have the 15,500. 15,500. Okay, that's what we have. Okay, so this is deducted from there, and we claim that we have the 15,000, all of it claimable. Okay, 500, all of it claimable. So meaning it leaves us with a figure of 500 here. That is 202,500. Okay, so that's what remains. It's 201, actually 201. Okay, 500. So that's what is going to remain. Okay, that is what is going to remain in this particular case. So we put it there and say that is out. Okay, so now that is for 2014. 2014, this is what we have as income tax value. As income tax value. About that. Income tax value. Income tax value. Income tax value. Income tax value carried forward. So this is carried forward to 2015. So this is carried forward to 2015. So 2015, that's where we start with what we carried forward is 2001. So that's what we start with, 2001. 2001, 500. 500. Okay, 2001, 500. So that's what we started with. Okay, that's what we started with. So that's what we're going to see happen there. Okay, fine. So now remember that the disposal proceeds, according to the question, we are told that it was sold when it was sold for 500,000 kwacha. Okay, so sold for 500, including cost of land, which is 100,000. So disposal proceed will not exceed the original cost. The original cost is the qualifying cost minus the cost of land in this particular case. So that is to be removed. So look at that. we have disposal proceed of 400, which is 500 minus 100, restricted to allowable cost of 310. Okay, because that's what we have, 310, that is what it's restricted to. So then we move that one out. Okay, what do we see? So we have to get the difference here. What is the difference? What is the difference? It is 500 there, then there is 1 here. Okay, there's 1 there. What should I say? Let me use a Casio. Use a Casio quickly. Okay, we have 310. 1, 2, 3. Okay, minus 201, 500. We're going to get 108, 500. That's correct. So 108, 500. 108, 500. Okay, so that was correct figure, 108, 500. So what happens in this particular case? Since the disposal proceed is higher than the income tax value at the beginning, this is known as a balancing charge. This is known as a balancing charge. And the balancing charge is going to be a subtraction. It's going to be a subtraction from the capital allowances. So we can as well put it in parentheses to show that it will be subtracted. Okay, so that's what we do. This is what is going to happen. So that is recovers all industrial building allowances given because building sold for more than original cost. It has not therefore fallen in value. Okay, so that's the idea. So that's how we calculate the capital allowances for this particular situation. Any challenges? Any questions? Do you have any challenges? Okay, I take it is fine. Okay, I take it is fine. Any challenges so far? Okay, we don't seem to have any challenges, so that's what we look at when we talk about industrial building. Okay, so now there's also the other part which I need to emphasize on. This relates to building sold after non-industrial use. Yes? Hello?
It's clear, sir. It's
Okay,
clear.
great. Okay. Building sold after non-industrial use. These are another point need to be considered when dealing with capital allowances. The fact is that where industrial building is being used for non-industrial purposes at the end of accounting period, then no capital allowance is given for that accounting period. Okay, so you can have a building, then there is an interruption in a trade. Okay, so what happens to that when you resume? That particular period when there is no trade or no business, we are not running business, that dormant period, those periods you cannot claim capital allowances. Okay, but you have to calculate. However, the cost of building is written down by a notional capital allowance. You have to still calculate the capital allowance, because when you resume using it as for the trade, you need to know how much is the income tax value. So that gap does not affect the writing down of the cost of industrial building. It has to continue. It's only that during the time when the building is dormant, you cannot claim capital allowances. Meanwhile, you have to still deduct you have to reduce the cost by the capital allowance which is supposed to be claimed in that year, which since it's not actually claimed, but you have to calculate it, it is taken to be called as notional capital allowance, notional capital allowance, because it's just claimed for the purpose of reducing the value, so that you keep matching what is the what is the period of usage of how many charges have been passed and what is the value at the end, for the purpose of determining what is the income tax value when you resume using it for trade. Okay, so if after non-industrial use a building is sold for more than its original cost, any balancing charge that arises is limited to the total allowances actually given to the company as a deduction from its profits. So that's how it is done. Okay, that's how it is done. So you have to take note of that as well. Okay. So I did mention the issue on the issue of low-cost housing. Again, I want to emphasize on low-cost housing the following points. Okay. One, that a building constructed or acquired by a person to provide housing for a purpose of his business at a cost of each housing unit not exceeding 20,000 to be specific is an industrial building referred to as the low-cost housing. The current law, it tells us the maximum cost for a low-cost housing is 20,000. Okay, that is what is specified. Low-cost housing qualify as an industrial building if the cost of each building unit does not exceed 20,000. That's what I'm trying to emphasize. The cost of any housing unit that exceeds 20,000 will not qualify for industrial building. Okay, so that it means that it will be left out. Okay, so if it is part of the composition of the building, you find that the low-cost house, which is used for as a dwelling, is costing more than 20,000 per unit, then that should be taken out. Okay, that should also be taken out of the total cost to remain with a qualifying cost for capital allowance purposes. Where housing units are flats, then each flat should be a housing unit for capital allowance purposes. Low-cost housing attracts wear and tear allowance of 10%. Okay, so unlike what we saw when you're looking at the other kinds of other types of where did I calculate this one? I did mention something like the rates. Okay, remember very well, I did mention here. So for low-cost housing, the only change will be here. For low-cost housing, even wear and tear allowance will be 10%. That's the difference. Okay, that's the difference. So take note of that. For low-cost housing, where wear and tear allowance is supposed to be 5%, excuse me, it changes to 10%. So low-cost housing, all the capital allowances will be at 10%. Okay, so I take it back to what it was. This is 5% for the other part. Okay, so let's get back to where we are. Okay, I did mention this. Looked at this. Okay, we looked at this, looked at that. Okay, and then I've started mentioning these points. Low-cost housing, wear and tear allowance is at 10%. The initial investment allowance are all 10%. So that's what I'm trying to emphasize. That is what I'm trying to emphasize. So qualifying allowance for low-cost housing, qualifying as industrial building, low-cost house qualify for industrial building allowance in the form of wear and tear at 10%. That's the emphasis I'm trying to labor here. Whereas the investment allowance and the initial allowance are all at 10%. So that's the point I'm trying to belabor here. So what happens when you dispose of a low-cost house? Okay, just like before, you might have a balancing charge or balancing allowance. Again, to emphasize, a balancing allowance happens when the disposal proceeds are less than income tax value at the beginning. Okay, a balancing charge is the opposite, when the disposal proceeds are more than the income tax value at the beginning. Okay, so that's what you need to know. Okay, now the buyer of used low-cost house gets wear and tear of 10%, but does not claim initial and investment allowance because that is a second hand. So initial and investment allowance are only claimed by the owner when the building is first commissioned. So when you bought a second-hand building, that cuts you out from claiming initial and the investment allowance. So that's what is being emphasized there. Okay, so that's what we can say about industrial buildings, or that's what we can say about industrial building. You need to know how to calculate the qualifying cost. You need to know how to calculate the qualifying cost when there is a non industrial building part, like a warehouse, which is a commercial building, because it is treated differently. Okay, we need to know what happens if you are disposing of a building. You can have capital, don't claim capital allowances, but you can have balancing allowance or balancing charge. Are we together? So that's what we can say about this today's presentation. So I would like to believe we have gotten 1 or 2 points. The next time we meet, we are going to look at commercial buildings, allowances, capital. How do we claim capital allowance on commercial building? So I'd like to believe we have done justice to this particular part of the presentation, or capital allowances. If there are any questions, you can drop me a comment, so that maybe next time, before I start looking at commercial building, I start by tackling what you have raised. Otherwise, we're going to end here. Thank you for listening, and I really treasure your commitment. That is all we have for today.